Guys, last month was kind of more the basic, so every month there's a class about mortgages. So, hi Estrella.
Good morning.
You did not want to come in the rain to come here in person?
I can't come in the office right now.
Oh, all right. It was just, I was thinking as I was driving in, I was like, oh, we might have more people on Zoom today than normal because it's gross.
I would have gone. I'm not able to get in today.
If you what?
I'm not able to go in.
Okay. Well, I'm glad you came on Zoom.
Thank you.
I think that worked. Let me come up here, sit in the crowd. You can sit with me, come on. Just the balloon. Can I make it so? I wanna see them here. Can I do that? I think so. I feel like I can, maybe you can get. Sherry in here though. They're also regret that. Maybe if I'm just sharing. Do we have one? I always have a hard time with this computer, like this setup. Yeah. See, I have to get carrying it here. Well, I think it's, okay, so I can't go into the presenting mode yet. Bear with me, Zoom people. Morning, everybody. Thanks for coming on. Oh, perfect there. All right, well, I know to call you, but you don't. I mean, I don't know if this is great, but you know, it is what it is, so. Go for it. We'll give it just another minute, see if anyone else pops in here.
Joel watched the Super Bowl last night.
Oh, yes.
That was wild, but it went to overtime. I was like, all right, well, I guess it's staying up later tonight then too.
I did not really watch it all. I mean, I really didn't care, so, I really was like rooting for Kansas City because Sandy's a huge fan, so I was like, okay, I'll have her back. But, yeah, I mean, I watched part of it. We went out to eat with some friends and stuff, and then when we came home, we were like going to bed and like Brad came in. He was like, oh, they wanted it over. He was like, I had it on his phone or whatever. Yeah, like, okay, cool. Okay, I can sleep, but whatever.
We watched the whole thing, but we had some people over at our house.
Yeah.
And so I was like, all right, well, I feel like I have to stay up since there's people still here.
Yeah. Well, that's the thing, like, because we used to live in California, and so in afternoon, like it starts at like 3:30 there, 3 o'clock, you know, so it's very different on like these, you know, because like you're up till 11, you know, I mean, you are wherever you are, like that's late for me now. I have to get up and go to the gym, I'm like, no, I need to be in bed. But, I was like, yeah, I do miss that, because I would go to parties just because I never really cared. Yeah,
I'm there for the food.
I know, I'm there for the food and the socializing and, you know,
All fun things.
I can enjoy an exciting thing, but. All right, y'all, can you hear me okay? And can you see my presentation?
Yes and yes.
Thanks, Cam.
Yes.
Awesome. All right, y'all, we'll get started. I don't know that this one's really gonna take us an hour today, but I just really wanted to go through and share with you guys what we are looking at when, in terms of seeing if someone is ready to be refinanced. I know going through last year with all of the higher rates, closing people, one of the, you know, what do you call it, pushback that you kind of get is like, oh, we want to wait till rates to fall. So we're always trying to educate people on, don't wait for rates to fall, buy your house now, we can refinance you later. So I thought, let's go ahead and teach you guys a little bit about what that refinance looks like, what we're looking at, so you in turn can help talk to your clients too, rather than just being like, oh, you can refi it later. If they have questions, or they're like, well, what does that really mean? How much does that cost? Blah, blah, blah. this will give you a little bit of the knowledge of what we're as a lender looking at, in determining if they're ready. So, okay, so why would you run a refi? Now, this goes beyond just, okay, I closed 6 months ago with an 8% rate. So this could be someone who maybe has been in their home for a long time, maybe their rate's even lower right now. I mean, we still have people that have rates in the 3s and 4s that are looking at refinancing, not because they're lowering their rates. So that's one of many reasons that someone would want to refinance. Okay, what is this? Oh, come on in. Oh, sure, you can record it. All right, so lower the rate, obviously that's the top reason most people think of to refinance their house. Another great one is they want to change the term of the mortgage. So maybe they got a 30-year, maybe their income is higher now, or, you know, whatever, maybe reasons, maybe they can afford that higher payment and they want to shorten that term. Because even if they've got a 30-year, say with a 4%, but they could get a 15-year with a 5%, yes, the interest is higher, but they're amortizing it over such a shorter period, you're still paying less in interest overall on the loan. So shortening the term is another main reason people look at doing it. Eliminating the mortgage insurance. So say they close, especially with an FHA, but that's a whole different reason, but if they closed on their property, say it was a few years ago, they put down less than 20%. I wouldn't refi only for this reason unless the rate made sense too, but this is something else you can look at. Hey, I've got that equity now, so I could do an appraisal or something, or we could look at refinancing their mortgage if there was other reasons that would make sense. Maybe they're also shortening the term, maybe the rate is better. But they've also got that appreciation, so when a refi is done, a new appraisal is done, so we're going on with the current value is, not what the value was when they bought it. Change from FHA to conventional. So FHA mortgages carry the mortgage insurance for the life of the loan. There are certain instances where it's not the life of the loan, but that's only if you're putting down 10% or more, which is super rare on an FHA loan. So most people that do FHA, they want the 3.5%, that's why they're doing it. So that, in that particular instance with 3.5% down, that mortgage insurance stays on there. They would have to refinance out into a conventional loan to get rid of that mortgage insurance. So once they have that equity position of they've got 20% equity, that's when we would look at saying, okay, let's refi you out of your FHA into a conventional so you can get rid of that mortgage insurance portion of your payment. Change from an adjustable rate to a fixed rate. We saw a lot of this happening, 2015, 16, those years coming out of everything that happened in 06, 7, 8, where tons of people got adjustable rate loans. We don't see that as much now, every now and then, sure. Adjustable rate mortgages are still out there, still a good mortgage when it makes sense. So sometimes people will know, hey, I'm not planning on being here that long. I'm only planning on having this house a few years. Maybe they move a lot for work, whatever the case may be. And they'll do an adjustable rate instead, because the rate and payment are lower and it's fixed for a first period, right? So say it's a 5-year fix and then it will adjust. But maybe they decide, oh, I am gonna keep the house, or I am staying, life happens, things change. So if they've got an adjustable rate and they know they wanna keep the home past that period, then we'll see a lot of people want to go ahead and refi into a fixed rate mortgage. Obviously depends on what rates are doing. If they got their adjustable rate when the rates were high and they've fallen since, then there's not an urgency to refi that because your rate's not any higher, but. Combine a first and a second mortgage into one mortgage. So a first and a second meaning they've got a standard first mortgage and they've probably got a HELOC. It could be a second fix, but 9 times out of 10, that second mortgage is gonna be a HELOC. Sometimes they've taken it out later, they got the house, they got their mortgage, they built up some equity over the years, they wanted to take out a HELOC, either maybe do some upgrades to the house or pay off some debts or put a kid through college, whatever they use their HELOC and money for is fine. But they've got 2 loans at that point. So then they're looking at it and saying, okay, our HELOC rate is higher than our first, here's what our payments are. HELOCs generally are structured so that the first 10 years is a draw period. So you don't have any principal payment that's due. So your payments are low, but you're really only paying the interest on the loan for the first 10 years. That's what's required. So sometimes if they wanna really start paying down that principal, you gotta pay extra, which you can absolutely do. But sometimes people wanna just say, okay, let's just refi it together into one low rate. So we've got one payment and we're knocking out principal and interest, so that's a common reason. Debt consolidation is probably the most common reason right now, considering you've got a lot of people in homes that have lower interest rates than where they are right now. But they've also built up some other debts, especially over the last, handful of years. We've all felt inflation, all of those things with the pandemic, people's incomes and jobs changed. We know from the economic, reports and things that credit card debt is at the highest it's ever been. A lot of other debts people are carrying. So they may have a mortgage on their house with a 3.5% rate. But they also have a lot of equity, but then they're also carrying a bunch of debt on credit cards, maybe auto loans that are at 8 or 9%. Anything else they have, if they've gotten it somewhat recently, is very high. Credit card debt or credit card rates right now the average is about 22 to 25%. Like, that's crazy. So if they've got other things, and we have systems and calculators that help us walk through that with them. So if they're telling me, yeah, but my mortgage rate's really low, there's a couple options. They could look at taking a HELOC to pay off other stuff, which might be the best reason or the best route for some people. And we're educating them, we're talking them through their options. And if a refi is not the best option, obviously that's what we're telling them. But just know that for some people, depending on the amount of other debt that they have, a cash out refi for that reason, for debt consolidation refi, could be the best option. Yes, their mortgage rate is higher, but their blended rate, meaning their mortgage rate and all their other rates, now everything's paid off together in one loan, that blended rate overall is saving them hundreds of dollars a month. Over 1,000 on some that I've run, because the payments on everything, are a lot more than if they consolidated into one thing, so. Obviously, home updates, if they want a new kitchen, they can do a refi, pull money out, pull equity out. If they want to, they got a kid in college, hi, that's me right now, I can see why someone would wanna do that. So, or a combination of all of those things, kind of like we talked about, they might be shortening the term, paying off debt, you can do all of those things at one time, so. It's really just another financial tool that we're talking to clients about and saying, okay, you've got this asset that's been appreciating for years, you've built up wealth and equity in it. What other debts do you have? What are your goals? Do you want to redo your kitchen? Do you want to do this? Do you want to do that? Do you want to pay this off sooner? Let's look at all of the options and really structure what's going to help them meet their goals the best way. So all sorts of reasons to refinance, not just my rate's higher than it is right now. So, when should you refinance? That's a really common question too. Obviously when it saves you money. So, that's the biggest thing we're looking for. There's something called a net tangible benefit that as a lender, we're required to make sure is there. So that obviously, you don't have a lender just refinancing people over and over to close more loans. We have to make sure there is a net tangible benefit to the homeowner. So either a lower monthly payment, obviously, meaning they've got a rate currently on their mortgage, and today I can give them a lower one. I'm lowering their payment by their interest rate. Or we're lowering their debt payment, so the debt consolidation. Like if they've got a mortgage and it's a 4.5%, obviously we're at sixes today. I'm not lowering their payment based on the interest rate, but if I'm paying off a bunch of other debts that are really high interest rate, their overall, maybe their mortgage is $2,000 a month, but they've got another $2,000 in all their other payments, so they're really paying $4,000 a month for their mortgage and their debts.
Right.
If we consolidate all those debts, yes, their mortgage might go from $2,000 to $3,000, but they're still $1,000 better than the $2,000 and $2,000 if they were paying. So that is a net tangible benefit as well. Let's see, shortening the loan term, again, we kind of touched on that. So I'm going from a 30-year to a 15-year. So my payments are higher, but I'm paying that house off and paying less interest in the life of the loan. That's a net tangible benefit. Rule of thumb is about 3/4 of a point to a point lower. If we're looking at, hey, I want to refinance to lower my rate. So think of the people that we've really closed last year. where we're like, hey, get in the house. Once the rates do come down over the next couple of years, you'll be able to go ahead and refinance it, you'll have your house, you'll start building your equity, you'll enjoy the appreciation, all of those reasons to not wait for rates. Now we're kind of looking at it and saying, okay, as rates are, we know they're coming down, they already came down from, November. When should we refinance them? Like, is it ready? Are they ready to go? 3 months later, 4 months later? It depends. We're really looking for a minimum of 3/4 to a point lower before we even consider it. Do you have a question?
Yeah, I think it's also important to note that if you got that mortgage recently at a high rate, then it's the best time perhaps, in my opinion. But you're doing it 10 or 12 or 15 years later, the amortization schedule now is in your favor. And to refinance again, you start all over again, it might not be, unless the spread is so.
Yeah.
Rates are so, yeah.
That's definitely something that we're looking at, because what Ivan was saying was that as you go, say a 30-year mortgage, your amortization, the first early years, you are paying, way more in interest. If your payment is, $2,000, you're probably paying 1,900 and change in interest, roughly. You're paying, 1,900 in interest, 100 to principal. So every month as you pay it, the interest portion is getting a little bit less and the principal portion is getting a little bit more. So say you're halfway through a 30-year loan, now you're paying more principal than you are interest. So you're paying very interest heavy on the early years and very principal heavy on the later years.
Right.
So what he's saying is, if you've had the loan for 15 years, you certainly are not gonna wanna go in and refi the 30-year. Because you're losing stuff. So what you could do at that point, you'd be looking at a much shorter term, let's shorten that term, because now your loan balance is lower. So there's a lot of different things that go in. If people bought a year ago and we just want to lower their rates, we can even do a 29-year amortization if they want. I've done that for clients before. We can do really, as long as it's on the year, I can't do like 28.5, but we can do, the standard is 30-year, 25-year, 20-year, 15-year, 10-year, 5-year. If they wanna do, hey, I bought it a year ago, can we just do 29 years? Yeah, we can.
Really?
We're just amortizing that payment,
I
yep.
didn't know that.
Yep, so, if you've got clients who are thinking, well, we were in it, we've been paying, what happens to the payments we've paid for the last 2 years? Well, we'll just do it for a 28-year, then you won't feel like you've lost so much. So,
Is that a 28-year amortization or is that a 20-year loan?
same,
You're saying?
yep,
Okay.
basically, instead of giving them a 30-year loan, I'm giving them a 28-year loan.
Oh,
So if they had a 30-year loan and they paid on it for 2 years, I can refinance them and we'll just amortize the new one over 28 years, so now they got a 28 loan, so still, they're done 30 years after they bought that
they're
house.
paying a little more for.
Yeah, it's a little bit more, yeah, but it keeps them from repaying that interest again, if that's important, so. And again, it's, you're looking at what's really important to them, are they okay with, if they weren't paying their mortgage and their interest, they were paying rent, right? So that's all gone. So, it's all
Right.
relative in the fact of what you're looking at. Are they more concerned about keeping their payment as low as possible? Then even though they've been there a year or two, we just go ahead and do a 30-year, keeps their payment as low as possible.
Right.
If they're okay with it being a little bit higher and they're just more, and people have different hot buttons, like, hey, I don't wanna pay any extra interest. I'd rather pay a little higher payment, than pay the extra interest. Okay, well, we can amortize it however you want.
Wow, that's pretty cool. I know that. They
Yep.
could do 25 or 28 or
See, you
something.
learned something.
Absolutely, that's why I'm here.
How long have been in the home? That is definitely something we're gonna be asking, because I've got an estimate in here, a couple slides later, so you guys will see that. But we're looking at that, because if they're gonna be in the home for 1 year, we're probably gonna move next year. Okay, well, then it's probably not worth it, even if the rate is lower. Because there are gonna be some costs associated with it, which I will go over. So there is a break-even point. We wanna make sure that it makes sense. Are we combining lower rates, getting rid of mortgage insurance? That's something we're looking at. Because getting rid of mortgage, so you're going from an FHA to conventional, but the rate on the conventional is slightly higher. But if you're getting rid of mortgage insurance completely, still worth it, still
Absolutely.
saving money per month.
Yeah.
What are the costs of a refinance? We will get to that. What are the different ways to pay for it? So there are costs, right? There are gonna be closing costs and some fees. Not as much as a purchase, but they're still there. So do I have to bring it to closing, like when I purchase, do I have to bring, $4,000? Do I, how do I do it? Can the lender do it? Is there a credit? So with a refinance, you can actually roll the costs into the loan. This is not something that can be done on a purchase, but on a refi it can. So basically, you're using equity, essentially.
Right.
So say your mortgage payoff is $200,000, and say your house is valued at $300,000, whatever, making up numbers here. But say it's gonna cost, $5,000 to do the refi. So you could do $2,000 loan amount that pays off your old one, that's your new loan amount, lower rate, here's your new payment, you bring $5,000 at closing. 9 times out of 10, nobody wants to do that. We're gonna do a $205,000 loan for the new one, cover the closing costs in there. Payment is still better than it used to be, and there we go. They're not bringing anything to closing. So that cost can be rolled in, and I'll go over again when I've got a break even thing that we're showing them. Okay, so you do that, how long are you, saving? How many months do you have to save to recoup that initial output?
So it's 2.5% kind of rate,
It's usually not that high.
okay,
And there's some different things that we'll kind of get into when we talk about fees and how it's structured and the benefits of closing, which is one reason when we were kind of telling y'all when we had the no lender fee refis and stuff, and how there's that bonus when they close with us, and when we go back later to refi them, we're not doing lender fees, but then the other bonus is an intangible tax, which I'll let Amy talk a little more on.
right.
But, that's a really cool bonus, really, because we have a servicing department. So to get the benefit of paying the lower intangible tax, you have to be with the same lender, no changes to the deed, all of that good stuff. So, that's why that's something that they get with us that they don't get everywhere. Lender pays it in the rate. That's an option too, meaning just like when someone is purchasing a home, they can opt to take a higher interest rate than market. And instead, like the opposite of someone can pay down the rate, pay discount points to get a lower rate, they can also opt for a higher rate to then get a lender credit. You can do that on a refi too. You'd be like, I don't want a higher loan, I don't want to bring money to closing, give me the rate that's slightly higher where I'm covering the closing costs for them. So if you ever see or hear lenders advertising no cost refi, that is what they're doing. Nobody is eating somebody else's costs. They are giving a slightly higher rate so that therefore there's a credit. So just understand that, nothing's free.
The donuts and coffee are free?
What? Yes, the donuts and coffee are free, but the loans aren't.
I'm just kidding.
No, that's awesome. Okay, so the break even number. So this is where we're looking when we're going in, we're having a consultation with our clients. So let me back up a little bit, just so you guys kind of know the overall process. We close somebody, because we service them too, we talk to our servicing division, meaning in Salesforce, we'll actually get triggers now because their loans are being serviced by New Res, which is our parent company. Their loans are being serviced there. So we've closed them. We're already getting them for loans we closed last fall, right? Where rates were 7.5%, 8%. We're getting these little triggers saying, hey, here's an email, Aaron, look at this client. They could be benefiting from a refi. So basically it tells me this is their current rate that we closed them with. Obviously I know where rates are, and that's what's triggering this is where the market rates are. But it's not even, I don't even have to do it myself and keep track of my clients and all that stuff. The system is doing it for us, and they're letting us know, there's notifying myself, Matt, Hunter, all the loan officers, when a past client is at a place where that 3/4 of a point to a point, when it sees that it's low enough, they're saying, hey, it's a good time to look at this, maybe have a conversation with that client. So we're proactively reaching out, we're keeping an eye on that stuff for our clients. So they don't have to wonder or always be like, hey, what are rates? Are they better? Let me call her, let me find out. Yeah, so we're looking at that. So, and I have one, this is the one I'm gonna show you, my examples shortly here. So I'm calling him, I'm having the conversation. In this particular case, I was like, he decided, let's wait for a little bit, which I agreed with him because I really think rates are going to come down more this year. They're fine with their payment where they are. So we're gonna wait for it to get a little bit better. But that's just kind of how we do it. So it could be any reason. Now, those are rate reasons, right? So if a client you saw that that's only one of like 5 reasons that someone might want to refi. So if you've got clients, if you're making database calls and, you know, someone mentions they want to do some, you know, remodeling or this or that, or pay off debt, that could be, oh, have you thought about a refinance? Have you, you know, that can be something you can kind of speak to, knowing that that's a reason that someone might want to do something like that.
Right.
So anyways, the break even, so the cost of the refi, like we talked about, divided by the current payment minus the new payment. So that sounds confusing, but all I'm doing is saying, okay, say, the cost to do the refi is $4,000. Say the current monthly payment is $2,500, and the new monthly payment is gonna be $2,000. So they're gonna save $500 a month, right, every month, once we do the refi. So it's gonna cost them $4,000 to do it. So I'm gonna say $4,000 of cost divided by $500 a month of savings is 8. So 8 months they'll break even. So yes, there's $4,000 to do the refi, but in 8 months from now, which is why we're asking the question, how long do you plan to be in the home?
Right.
Because after 8 months, you are ahead $500 a month for the rest of the time you have that loan. So that obviously is one that makes sense, correct? Now, if the payment was, you know, $100 less, and it was $4,000 to do the refi, now we're at 40 months to break even.
Right.
I'd probably wait, you know? Even if you're telling me I'm gonna be in the home for 10 years, let's see if they get a little bit better, right? That's not,
And also by waiting, you may be able to waive the what do I say, the mortgage, the mortgage insurance.
yeah,
Because
exactly.
maybe by then the appraisal of the home would have
Let's
cut off
wait.
with it.
Exactly. So, but when we're having those conversations, we're walking them through numbers, so that they're not just saying, oh, you think I should refi? Okay, I will. You know, I want them to understand that. So
Right.
for every payment, in this scenario, it was 11.8 months, right? So that was the break even. The cost on that one was 55.83. They were saving 473. The cost divided by the savings was 11.8 months, so a year. So as long as these people are gonna be in their house, really, I'd say, if you're gonna be in your house 2 years or more, go ahead and do it. Cause that, you know, they're gonna save $6,000 on year 2 over and above it, so as long as they're there. Okay, so this, I'm gonna try to move y'all.
To the side or something.
Let's put you over here. Can I put you over there? Maybe I can. I'm gonna put you up here for now. You're not really in the way. Okay, so this is a snapshot of the one these guys closed in October. So I got the trigger saying that they were, you know, a potential, they had savings, right? So they had put already 20% down. So really right here, this is what their appraised value was when they bought the house. So 4 months later, it's probably not too far off from that. So this loan amount, this would be the new loan amount that I've calculated based on, here's our normal costs, right? So I left in the processing and underwriting fees, those 2 lender fees, which I'm going to be crediting them because we're not charging those 2 fees. Those are our lender fees for those that we closed. So, but I'm listing it here so they can see it. So tax service fee, a credit report fee, some title services, and I'll let Amy kind of go over a little bit like what the common closing attorney fees are. They are less than a purchase, but they're still doing work and they're still
Sure.
checking title and all that kind of stuff. They do not have to rebuy owner's title insurance because they already bought that. They do have to rebuy lenders because the lender's title insurance goes with the loan. So if we're paying off the old loan, they're getting a new loan. Now we've got to put lender's title insurance on that new loan. So that fee is there again, but not the half that they pay for themselves. They only have to buy that once. And of course, there's an intangible, or the intangible tax is low here because in this case, they're a client, nothing's changed. I'll let Amy explain that in a second. So really all the fees for theirs would be about $4,400. Now, over here, I've credited, so this is a credit, so that takes out these 2 fees right here. So 4,400 minus about 16, really this out of pocket is gonna cost them about $3,000, okay?
Pretty good.
Yeah, not
That
bad.
big of a loan, yeah.
Exactly, so here's the payoff of the mortgage. And then here's the new loan amount, because we are rolling the costs in for them, so they're not bringing anything, so you can see here, they're getting like $83 back. Now, I did have a couple of months here, for their new escrow account. So when you refi, say you're refining, I'll go over, when you refi with us, if you're already applying to refi with us, we're servicing your loan, we've got your escrow account. So we don't have to necessarily bring all the money to reset it up like you did when you purchased, because whatever's sitting in there, we're actually gonna apply it. And the 1 month and 1 month, I'm just really trying to show them more how the numbers would break out. I'm saying we might have to collect a little extra that's as a buffer because that they will skip a payment, all that good stuff. But what's in their escrow account, we can essentially transfer it over to the new one.
So you guys service them as well?
We service our one, yeah,
Okay.
yes. So that keeps their refi, keeps them from having to reestablish a brand new escrow account, which if they did, they'd be bringing, depending on when the taxes are due, when they're refining, just like
Lots of it.
purchase, it's all prorated, they might be bringing 8 or 9 months of taxes, all that good stuff.
Right.
Obviously, if that's the case, like if they're coming from another lender and they're refining with us, then they would be paying off the old loan, that old escrow account would be sent back to them, whatever's in it, so they're getting the money back.
Right.
But, you know, it's a little more work. They're having to pre-fund a new one and then get the old one back. In our case, we take that out, we say, okay, we got it, we move it over, all is well, that's easy. Obviously, there's prepaid interest still, depending on what day of the month you're closing. So in this case, they're not bringing anything to closing. They're paid off their old loan of $615, their new loan is $619, which covers this amount, less my credit of $1,600, but also it covers all of that, so that's about another $1,000. That's why we see it's about $4,000, even though their actual fees are about $3,000. They've got some prepayments that we're figuring they're still gonna have to bring.
Quick question. I've
Yeah.
refinanced before and I can't remember this. Stupid question. When you refinance, do you skip the next payment just like when you buy a house?
Yep, and the reason is because you're prepaying the interest for the rest of that month, because you can
Got it.
only pay for 1 month interest, right? If that's basically, you know, you can't pay March and half of February on your April payment. You can only pay March. So if you're closing in February, you've got to pay off the rest of February because the interest is paid in arrears. So the April 1st payment covers the interest for March, but it can't cover more than that.
So skip March toward April.
Yep, so if they refied in, I don't think I put the date, say they refied, that was the date I did.
Oh.
Yeah. Anyway, I have 4 days of interest, so, you know, if they're refining at the end of the month, say they're refining the 26th of February, the 25th of February, they will not have a March 1st payment, just like if they were purchasing. Their first payment's gonna be in April.
Nice.
Yep. So that's kind of what it looks like. Now, this section over here is, and this all goes to the client. This is the worksheet I send to the client. And then we hop on a call and we talk through it. And I'll show you an actual Excel booklet that I sent this guy. Because this is the current rate for today without discount points and stuff when I did these. But then, you know, we were talking about it and we decided, let's wait, let's see if it goes lower. He thinks it'll go lower. I think it'll go lower this year. The Fed hasn't even started reducing yet.
Right.
But he closed at basically the peak. I mean, they're at like 7.875. But he also did not pay discount because even our strategy at that point, we're like, don't buy it down. If you can afford the payment, and you're okay with it, let's just wait. We're gonna refinance you. So save that money. And then if you want to end up buying the next one down, go for it or not. I mean, you know, whatever. So anyway, his payment right now is 47, or this is the proposed payment. Right now, his total payment is 5101. So this is the breakdown of what he's currently paying. So his first mortgage right now is at 7.875, and that's his principal and interest amount right there, 4466. So we're literally going to 4066, right? So, oh no, didn't mean to do that. So taxes and insurance, obviously those are the same. So we're comparing 5101 is what they're at. We're saying, hey, if we refinance out at this rate, it's 4701.
$390 a month.
Yep, so basically saving him $400, $399.61.
Yeah.
So the total costs, now this actually I should redo now that I'm seeing that because that doesn't even include my credit.
Oh.
So that's saying it's 11 months out.
Yeah.
But really, it would be less than that because my credit right here, it's pulling from this number, so I should add my credit over here. Look at me, I gotta change my worksheet. So anyways, this is the break even, kind of like what we were talking about before. I'm gonna go out of this for a second. 'Cause I wanna show you guys the actual booklet that I sent to this guy. You share these.
I mean, 10 months, it covers the, cost of, doing it again
Yeah,
and instead of
yeah,
40
and
bucks a month.
you're much lower. Okay, so you can see I've got different tabs on here. So this 30 years, 6.875, this is the one we just walked through. So that's the snippet I had. But for him, I said, okay, oh my gosh, this is backwards from what I'm used to. So this is what you'd save, and this is what a refi would look at if we did it today, 6.875. I said, or we can look at different targets, and you can tell me what it is that
Awesome.
you, would like to do it. So if we wait for rates to get to 6.5, this is what your payment would be, you'd be saving $553 a month. Okay, yeah, I like that better. You know, I think that'll happen this year, I think, so. Okay, or if we made it all the way to 6.25, now you're saving $655 a month, right? So still pretty much same costs, you know, those aren't really changing much at all. They're not really changing at all, because it's loan amounts on. Or if we waited all the way to 6%, this is what it would look like. He'd be saving $755 a month. So this just gives him kind of visual of what the targets could be. Now, you know, we can certainly, obviously, we'll watch the markets. This guy watches markets. I know him, so he, and from working with him, he's gonna be paying attention to what the markets are doing. He's gonna be paying attention to those Fed rate cuts. He's gonna kind of be in the know anyways. But these are the notes I'm putting in my system. He'd really like to see if we can get closer to 6, like that would be ideal for him. Let's wait to refi till I can save, you know, $700 a month. Great, absolutely. I'm putting that note in. I'm also following up with him, you know, every month or whatever, just keeping an eye on things.
I mean, that's gonna happen within a year and a half, that makes sense. If it's gonna happen much later, then in the meantime, he's paying a lot more. So
Exactly. And that's exactly what it is. We're just gonna kind of watch this year. Let's watch the first half of the year, see how things start to go. When does the Fed start cutting? What does that look like? Because you're right. I mean, it's a trade-off. He's paying 8% or 7.875 now.
Yeah.
You know, and his break even would be like 6 months. In actuality, maybe 8 months in that first one.
Right,
So, you know, even if you refi now and then refi again in a couple of years, that's not gonna hurt him.
sorry.
But anyways, these are the kinds of conversation we're having, so I wanted you to kind of see, this is what we're showing the client. So if you've got anyone and they're interested, or they're not sure, or they're like, well, I got a lot of credit card debt, I got a lot of this or that, I don't know if it makes sense. Send them let us talk to them, because this is the kind of stuff we're showing them. Numbers don't lie.
If you are rolling some of the credit card debt into the loan, because a lot of people buy a house and the first thing they do is load up on the credit cards. Because they were not using it for a while before the closing, they start buying furniture. I mean, the first time home buyers, you know.
Yeah.
So when you are doing your calculations of DTI, does the fact that you're rolling that credit card debt into a loan factor in their favor for the DTI? You don't have to count that?
Correct,
Monthly payment anymore?
so that's a great question. So if they're doing a debt consolidation refi and they're like,
Right.
okay, here's our mortgage, it's 2,000 a month, here's my car payment, it's 600, here's my credit card payment, it's 500, here's
Right.
whatever. If they wanna pay all of that off,
Right,
then basically their debt to income ratio now, instead of 2,000 plus 600 plus 500 plus this, divided by their income, which is what a debt to income ratio is,
right,
it's just, hey, the new payment is, you know, 2,600 divided by the income. So it improves their debt to income ratio, because if we're saving them money, we're qualifying them on what their debt to income ratio is going to be
Right.
once the new loan is done.
and because the DTI is lower, does that help them a little bit on the interest rate, or?
It
Not really.
doesn't really help on the
Yeah,
rate, but
okay.
if they do have PMI, it can help there. Like if they still have PMI, so maybe they put down 3%, they bought their house and they're still, you know, they're refining, but they still are only at 10% equity or something.
Okay.
Or they're paying off a bunch of debts, so they still got, you know, whatever the case is, it does help with PMI, the lower your DTI is. Not like every little bit, but basically if you're under 40 or over 40, there's a difference, 40%. But interest rate, actually not really too much.
Got it.
But that's a great question as far as, you know,
DTI.
does it help them qualify? Yes, it does. I'm trying to go back. Oh, I don't want to go from the current slide. Here we go. All right, does anyone have any questions on the estimate or the numbers? I'm chatting, maybe they chatted a question.
Is your microphone on?
Oh.
No.
Understanding. Congrats on your team, Sandy.
Yeah,
Oh,
no,
hey.
she's there.
Thank you.
Yeah.
Thank you.
Did you have a question?
I didn't have a question. I was having trouble hearing for a while, but I think it was my computer, so I logged off and logged back in.
Oh, okay, can you hear okay now?
Yes, no problem. It was me.
Okay,
It's always
okay.
me.
It's always me.
Perfect. Okay, well, Amy, why don't you talk a little bit about the fees from the attorney side and explain, I think you can probably explain the intangible tax better than I can.
Well, I'm happy to jump in. So I get the question a lot for a refi, why am I repaying these fees that we had for the closing attorney? And the long answer short is that when you're doing a refinance, we have to, like Erin said, when you're paying off your previous mortgage, that lender's title insurance policy basically is sold off with it, if you wanna think of it that way. So you have to get a new lender's title insurance policy to cover the new amount of the loan. And because they're getting a new loan on the property, we have to again run title. And the purpose of that, even if you're gonna, and I've had people say, well, I still own the home, obviously.
Yeah.
Well, yes, you do. But there could be additional tax liens on the property. There could be a
Sure.
whole variety of different things that have now attached to the property from the time that you initially purchased the home, potentially put that first mortgage on it that's now being paid off, and now obtaining this new loan or new HELOC, whatever it may be. So we have to make sure that the title is as is, that there's nothing that would be, putting the lender not in first position. And what that means, basically, they have to have first priority on the loans that's required in the closing, instructions to the closing attorney. Basically that if something happened, if you were not making payments, that would allow them to get their money up above any of those other attachments that could be on the property. So, and again, the biggest thing for that is check your tax liens. And that's income tax liens or property tax, anything like that on the property. Granted, if you have an escrow account, that's not gonna really be an issue, but there's a whole variety of different things that we're checking for.
Unless it's their personal taxes.
Yes.
I've seen that.
Yeah, there's all kinds of things that can attach to the property. But so that's, and if you kind of look at this chart here for closing attorney charges, that's exactly what that is. So that's for us to review that title again, make sure everything's good, for us to also actually physically do the closing again as well. Lender's title insurance, again, you've got to get a new policy. Anytime you get a new loan on the property, you got to get a new lender's title insurance policy. Owner's policy is not going to change. You still own the property, you do not have to purchase that again. Whenever you initially purchase the property, when you purchase that OTP, it's good for as long as you own the property. So you don't have to keep repurchasing that. For the intangible tax, so this is a good one for refinance. The catch with that is that it's gotta be with the same lender. It's gotta be the same person that's giving the new loan. So if it's, let's say, me and my husband, and it was initially just him on the loan, and now it's me and him, that may not qualify for it to actually be with the intangible tax. If the initial loan was me and him, the new loan has to be me and him for that to qualify.
Okay.
I have seen occasionally, and you may even have seen this too. So when we purchased our home, it was both of us. I had my name and my married name. But I've actually had instances where even if that person's legal name has changed, that may not qualify for them to get that intangible tax. I've had I think one exception in the past where it was allowed. But that's the kind of stuff you have to be kind of on the lookout for. It's gotta be the same lender, same borrower, same people that are getting the new loan. But
We can't add anyone to title or anything.
Yeah, can't add
Like,
anyone to
Can you
title.
quit claim deed someone on there after?
Yeah.
So like we were very, asking a lot of questions, especially last year, knowing people are gonna wanna refi, these are perks to stay, refining with us, like, okay, are you, you're married, but only you're gonna be on the loan. Is your wife gonna be on title, or is your husband gonna be on title, or whoever? Yes or no, okay, well, let's do it at closing, so that title is the same. So coming back later in the refi, we don't, you're not like, okay, well, we added her a month after we closed. No, and we were kind of explaining that.
But you
Yeah.
can't Is that,
You can, but now you're paying the full intangible tax, and you can kind of explain the difference, but.
I mean, even afterwards, I mean,
So the catch is, I think so basically, let's say I close on my home, I'm the only one on the loan, and my husband Dan is not on the title.
right,
So if I then, after closing, which is okay for title aspect, and it doesn't violate that due on sale clause, I can, on a title aspect, add a spouse to title, and it's not an issue. The issue comes about if you're trying to do a refinance and you're trying to avoid the intangible tax, because now he's on title to the home. And so if he's gonna then be on the loan as well, that's not gonna qualify for intangible because it's not the same person that's getting the same loan, not the same loan, but.
There is a change,
Yeah, there's a
basically to the title. So
yeah,
for the intangible tax to have that waiver where you don't have to pay the full tax again, pretty much everything has to be the same on the first loan and the second.
Like,
Title, yeah.
well, but I might like a month later or 2 months later,
what was that?
If you do after the refinance
yeah,
and you wanna add someone, that's fine.
right,
You know, it's just a matter of how it closes, whose name is it in, whose name is the title in. When we go to do that refi, it has to be exactly the same.
Got
If it closed with just Amy's name originally, and then we come back to refi and she has since added her husband, now, we can still refi them, of course. But now they're paying a higher intangible, like it's brand new, like it
Got
didn't matter that we did the first one at that point.
And the other catch with intangible tax is that you benefit from the intangible tax up to, I wrote this down, up to the amount of the unpaid balance on the note.
Yes.
So let's say that my initial loan was for $200,000, and I now have $100,000 left on that. You can only get the intangible tax up to that. So if I then later wanted to do a refi for $500,000, I'm not totally exempt from that full amount of the intangible tax. It's up to that unpaid balance. Because at that point, you know, you're taking out more than you took out before, so you've got to pay that difference. But it still is gonna give you a huge credit for the amount that you would normally be paying. Does that make sense?
Yeah.
yeah,
Yeah, like on this one, you know, say their original mortgage was $615, their new loan is $619. Instead of paying intangible tax, which is what again, what's the percentage?
Oh, gosh.
I can't
It's
remember.
like 50 cents for every 1,000, and then you
Some-
round up something.
Yeah,
We haven't calculated.
She has a calculator in it. But normally, if you aren't refining with the same lender, that's the same, like we're talking about, they would be paying the intangible tax for the new loan at the full, it would be on the $619,000.
sure,
But since we're avoiding it, or when we call it the waiver, or it's not really a waiver, but it's a vast reduction, we're now, instead of paying it on the entire new balance, we're paying it on the difference. So like Amy was saying, the original was $615, we're taking out $619, now we only have to pay that tax on $4,000, not $619.
gotcha.
So you can see it's a pretty, I mean, it can be a very big number.
It's significant savings.
I actually could probably. If I can look.
Yeah, the intangible tax is always gonna be typically the highest amount that goes to the county. Your transfer tax, you're obviously not gonna pay again because you already own the property. The transfer tax is just like the owner's cost, you only pay it during the time that you acquire it. That is $1 for every 1,000. The intangible tax is gonna be much higher than that.
So like $3,000 in this case, something like that, that's what I'm calculating, about 3,000 in this case.
A little bit.
I'm gonna try to actually,
Yeah.
like, screw this up. I'm gonna.
And another, when Eric was talking about reasons for a refinance, another reason I've seen from the title side. It doesn't always come up, but it can come up when there's a divorce happening. If one spouse is having to buy the other out of the property, it may even be a requirement that's listed in the divorce decree. Is that if they were both borrowers on the initial loan, that the other one doesn't want to continue to be on that loan. Doesn't happen all the time, but I have seen that listed where it's a requirement for them to buy the other spouse out of their portion. And then in that, especially when they were both borrowers, they gotta get that one off the loan. Does that make sense?
Which is a refi,
Yeah.
because you cannot just remove someone from a loan.
Right.
So, just for fun, I changed that. So that's what they would be paying, 1863. if they had to pay intangible tax on the full. So if they close with one lender and then they go refi with somebody else, that's the difference. And, you know, the other one was $15. So
Okay.
that's, you know, we're talking a lot of money. I mean, it's a pretty good chunk, so. Just so you're kind of aware there. All right, let me go back. I think we're pretty much done. Oh, here's my questions for the attorney. I think we probably already did most of those. Intangible tax we did. You already talked about that.
You need to close an attorney's office, yes. In the state of Georgia,
Oh, you
it's,
do?
yes, it
Okay.
is an attorney state, you need to close in an attorney's office.
I mean, I guess unless they want to come to your house, but most attorneys don't want to do that.
I've done a couple, but
Yeah.
not, it's gotta be a really good reason. They're probably gonna make up them with me.
Yeah, so just remember, I mean, it is a brand new loan. So it's pretty much all the same loan documents as the first time they bought it, so, you know, you don't have the seller side, obviously, but, you know.
Yeah, it's
The bulk of what they sign at closing as a buyer is lender docs, so the refinance is the same.
a lot of the same documents, just with your new loan info.
And if you got multiple people on title, they've gotta be there too, so same as the purchase rules, so.
Gotcha.
Yep.
Do y'all have any questions on the attorney side too?
Yeah.
No?
Does that make sense? Did you guys learn something? I know refinance is not in your normal, you know, you're selling houses. But I just thought it's a good thing the more knowledge you have, the more things you can listen for. You know, as rates come down and you're making database calls, I mean, that's just another good reason for you to reach out to your clients with
Yeah,
their best
exactly.
interest in mind.
When interest rates go down a little bit more, probably.
Yeah.
But it's like I said earlier, I've refinanced twice at least, and you just go through it and you forget the details about it, you know?
Yeah,
So
yeah.
this is good.
But yeah, we're really passionate about making sure they understand the benefits, making sure there are benefits, you know, I mean. We want, you know, we don't want to do a refinance for someone if it really doesn't make sense to them, to, you know, get another one.
Also, we probably said this at the
I've
beginning.
told people before, like, yeah, I wouldn't do that. Or, hey, I got, you know, they're serviced maybe by somebody else, you know, they're not my client. And they're like, well, I get a call from, you know, a lot of loan servicers have call centers that call them and, you know, they'll be telling them at half a point, like, oh, you wanna refinance, the rate's lower. And it's like, when you really count it all out, no,
Right.
it's not a good time. But there's plenty of lenders out there that will go ahead and do it, and if the people say yes, you know, so really, like, that's just not how we roll in day to day anyway, so we're very. But those worksheets, I mean, I've used that same Excel book for years, yeah, I'm like, whatever. It's not fancy, but all the formulas are there, we can plug in different loan amounts, different rates, it calculates things. I can send it to them, you know, with the different tabs, the different rates, we can look at options. And, you know, kind of puts them back in the driver's seat a little bit, but we're there to guide them, yeah.
Yeah, you probably covered this at the beginning and I missed it. How soon how soon after they purchase a house should they refinance? Like a year out? So allow for the credit to, you
The
know,
general rule of thumb is they really wanna be in there about 6 months. Technically, it's they wanna make 4 payments. If you start refinancing before that, one, it's a negative on the lender, so to tell you a little bit about how it works, especially say Fannie Mae, Freddie Mac, they're all investors, right?
Right.
So any lender, us, we're a direct lender, a bank, a broker who's using a bank, basically anyone, when they do say a conventional loan, once that loan is closed, that package is all, you know, packaged up and it's shipped off to Fannie, Freddie, FHA, whoever that investor is. We don't keep the actual loan. We service them, meaning we collect payments. Some lenders don't do that either. They send the servicing off, you know, they sell the servicing. We
Right.
actually have a servicing division, so we don't do that part, but we do send the loan off. That's actually how we as lenders, as companies get paid. So we're not collecting all that interest and stuff like that. We do the loan, we send it and sell it to Fannie or Freddie or FHA. That's why when we say, you've ever heard the term, you know, the loan has to be sellable, or the loan this or that. That's Fannie and Freddie, they all have their guidelines, we have to follow those guidelines, and that's why. Because we have to make sure everything's checked out, we've met all the requirements for them, because they're getting the loan. Lenders don't hang on to those loans, Fannie, Freddie, those guys do. So when we send it off to them, basically, if the loan gets paid off, meaning we refinance it 2 months later, they're gonna give us a buyback. Basically, they're gonna be like, we don't even have this loan anymore. We paid you to buy this loan, now you need to pay it back.
Wow.
So that's where the 6 month rule really comes in for lenders, because that's how, if they start refinancing all their loans 2 months after they do them, they'll be out of business because they have to pay Fannie and Freddie all the money
Right,
back.
well, was I think that the credit score on the client hasn't really improved yet, or because they just started paying a new debt? So
Yeah.
we'll give it time to,
There are a lot. And
right,
I mean, honestly, if the rate's, down 3 months after they close, it'll probably still be down 3 months later, maybe better, if you think of the situation we're in. I don't think there's necessarily a huge rush.
no, that's cool, I was thinking a
But-
year, a year and a half.
Yeah, no,
6
6 months is the rule, that's kind of what guidelines say.
And you get paid and you have to pay it back, that's good.
Yeah. Yeah, because and that's like if something's wrong with a loan ever, or, a lender closes it, and that's why sometimes you might actually be, oh, well, this lender won't do it, but this lender says they will. And sometimes we're actually pretty lenient, we don't have a lot of overlay, so every lender starts with the guidelines, which are the minimum guidelines for the investor, for Fannie, Freddie, FHA. A lender has to meet those. They can add something on it, like they could say, okay, well, they allow a 580 at FHA, but I don't want any loans under 620. So that lender could say, our minimum credit score is 620 for FHA.
Gotcha,
FHA will take less, but that lender's not going.
gotcha.
So you can make anything more stringent, but you can't make
Maybe a
it
little
less. So sometimes you might see a lender say, yeah, we won't do that, and another lender will do it. So a lot of times that's an overlay, that's the reason for that. We have very, very few overlays, but we certainly won't risk getting a buyback. So if it's really
Oh, yeah.
shady and that's the guideline, the underwriters are probably gonna err more on making sure that, it's gonna mean Fannie or Freddie aren't gonna be able to kick this back to us.
But underwriter is only the investors underwriter, they look out for them, obviously.
Well, yeah, and I mean, for their job, if they start getting a bunch of loans bought back, it's that they're gonna lose their underwriting.
No,
job.
definitely, yeah.
But that's kind of, they give you a little peek behind the curtain, that's sort of the back end of things and
Yeah.
how that works.
So the only time that doesn't apply is when you get what is called a portfolio loan, right?
So a portfolio loan is gonna be different, but we're our own backers.
Right,
So like our new res, our smart series, the smart vet, the bank statement loan, they still have a guideline, but they will, some of them they'll do
Stay with you.
exceptions, sometimes they won't do exceptions, depending on, but yeah, it's not going out to somebody else. Jumbos, they're going to different investors, which are usually all banks, like they're chasing jumbo as well as jumbo.
what's a jumbo now, what is it, still 7 something, or?
No, we got jumbos are in the sixes. Now,
Oh, it went down to 60s, it was like 725 at 1.760 or something.
credit score?
Yeah, no, the loan amount,
What is it? It's $1 above the conventional, 726 and change now?
okay.
Yeah. Oh, sorry. You're okay. All right, anybody, any other questions? No, I didn't see that. Oh, there is a chat.
Can we get copies of the slides? If we be or no?
Yeah, you can. I don't think, yeah, I'll PDF it and send it out. Was there a chat? Did I miss it? There's a chat though.
Yeah, try there.
Oh, yay, you're welcome. All right, y'all, well, if no one has any other questions, I will release you. I didn't
Thank you.
actually think this one would go that long, so hey, yay.
Wow.
All right, happy Monday, thanks for coming.
Thank you,
Thanks,
guys.
Aaron.
Appreciate it.
Thanks, Amy.
Thanks, guys.
You have any questions?
All right.
Amy, Bennett,
He's good, he's walking around,
so he's what, 10?